Hello and good afternoon, guys. So, I'm recording this video on a Sunday afternoon. So, you would be wondering why I'm wearing this jacket. So, I'm a bit under the weather. So, today's topic is how to trade in stocks. So, we are going to discuss about long trade, and second is the short trade. So this covers chapter 2, that is the investment process. So little bit background about how trading works. So trading in stocks, if you see globally, so it works either through broker medium, either through brokers or through dealers. Now the major difference between broker and dealers is broker doesn't have inventory, so they just facilitate the trade. That is, they facilitate meeting between buyers and sellers. So they charge commissions from buyers as well as they charge commission from sellers. So they do not take on any inventory, so they just facilitate meeting between buyers and sellers. So they have no inventory. So inventory is no, there is no go towards inventory. Then dealers have inventory. Okay, so they buy from buyer, they keep it in their inventory, and then they sell to seller. Okay, so the person who is selling, dealers buy it from it, buy it from them, keep it in their inventory, they find an person who wants to buy, and then they sell that, right? So they have inventory. So major difference between dealer and brokers are brokers doesn't have any inventory, broker medium doesn't have any inventory, dealers generally carry inventory. Now the important point to note is brokers generally charge commissions, and they charge commissions from both buyers as well as sellers. Dealers do not charge commissions, they create a spread. Okay, so spread is nothing but difference between buying price and selling price. Difference between buying price as well as selling price, and that is their margin or gain. Okay, now you can have a combination where a entity is working as a dealer as well as a broker, so he may charge spread as well as commissions, and all kinds of other combinations are there. But majorly we trade on two channels, brokers as well as dealers. Brokers do not have any inventory, they just charge commissions from buyers and sellers, and they facilitate meeting between buyers and sellers. Dealers generally carry inventory and they create spreads, and the spreads are their earnings. Okay, so just to ponder on that point that we have just discussed, we'll take an example. So how would a broker work? So ignore my typos. Yeah, that's totally wrong. So how does a broker work? So let's say we are trading on Apple stock, which is currently at $170. If Mr. A wants to buy it and Mr. B wants to sell it, how would a broker work? Mr. A, who wants to buy it, would approach a broker. Broker which will find Mr. B, who wants to sell it. So it facilitates meeting between a buyer and seller. And for doing this service, he will charge commission. So let's say, for example, 0.5% commission from buyer as well as 0.5% commission from the seller. I'm just throwing a number. So broker will get, so we have a dollar sign, so multiplication won't work. So broker will get 0.5% multiplied by 170 and 0.5% multiplied by 170. So broker is making commissions, and the total commission for the broker in this case is $1.7. Okay, now is broker buying it from Mr. A and then selling to Mr. B? The answer is no. So a broker doesn't have any inventory. How will a dealer work? Dealer will work, so Mr. A, let's say, is willing to sell this stock at 169, or he's willing to buy it at 170. He's a buyer, right? So $171 is his budget. He is willing to buy it at $171, and Mr. B is willing to sell it at $169. So it is his MRP on the stock. Okay, so what will a dealer do? Dealer will go to Mr. B, buy that stock, so buys it, keeps it in the inventory, and then sells the stock to Mr. A. What is the gain that he is making? He is selling it at 171, he is buying it at 169. So total gain from this that the dealer make is $2. So brokers work on commission, dealers work on spread. This is called as the spread, difference between buying and selling price. Now coming back, irrespective of whether you are trading on a broker network or on a dealer network, you have two kinds of trade that you make on stocks. Actually there are three. There is a cover trade, but we'll cross the bridge when we come to it. Okay, so what is a long trade? So before going into long and short, there are two mediums to trade in stocks. First is cash and second is margin. Now what is cash trading? Cash trading means you buy in full. So buy the stock in full. Okay. Margin trading means you take leverage. So you do not put the entire amount that is required to buy the stock. You just put in the fraction of the amount that is required to buy the stock. The rest of it is given to you on loan. Okay. We'll see how it happens. But there are two ways to trade in stocks, cash or margins. Cash is where you buy the stock in full and you sell the stock only when you have it. So you sell the stock only when you have it. In margin, you do a long trade. That is, you buy first and then sell later, or you do a short trade where you sell first and buy later. Okay. So let us go to an Excel sheet, take an example and understand both of these things. So let us first look at cash. I'll rename it as cash. Okay. So let us continue with that Apple example. Apple stock is at $170. Okay, you are doing a cash trade. So when will you do a cash trade? Cash trade is generally done when you want to hold the stock for long term. Okay, and you want to benefit from the rise in price as well as dividend that the stock pays. So you want to benefit either from the increase in price or you want to benefit from the dividend. So if your objective is long term and you want to benefit from rise in stock price as well as from the dividend that it is providing, what you will do? You will do a cash buy. So what happens in a cash buy? Let's say you want to buy 10 stocks. So you would have to deposit 170 into 10. That is $1,700 to get into a cash buy position. So the stock will be delivered to you, it will be held in your investment account, and you become owners of that stock. So companies' corporate statements are changed when you trade in stocks, because they have to change the owner of the stock at the company's end. So there is a settlement cycle that takes place. So whenever you buy in stocks, the stock actually gets delivered into your investment account. Another important point to note, you have to put in the entire amount. So if the stock is $170, you want to buy 10 stocks. So 170 into 10, $1,700, you have to put the entire amount. How long can you hold the stock? Until you want, or the company gets delisted, or let's say the company goes bankrupt. Until then you can hold the stock, because it is getting delivered in your investment account. What happens when you do a cash sell? When you do a cash sell, first is you should have that stock in your investment account. So stock is there in your investment account. Only then you can do a cash sell. So you can sell the stock and get the money. So you cannot sell a stock that you do not own. So in cash trade, you benefit from 2 points. From the share price increase that the stock exhibits, and the dividend that the stock pays. So you benefit from 2 points, share price increase as well as dividends. You cannot benefit in cash trade by the fall in share price. So you cannot take the benefit of fall in share price. You only benefit if share price goes north, that is, it goes up, because you cannot sell the stock that you do not own in cash trade. Okay, so this is cash. You buy in full, you benefit from dividends, you benefit from share price growth, and you get the share in your demat account, means in your investment account. The next is margin trade. Now let us compare margin trade on Apple stock. So the stock price that we are considering is $170. Okay, first trade that we are going to do is a margin long trade or a margin buy. So what happens in a margin long trade? Okay, first point, you do not have to invest the entire amount to get into the stock position. You just have to invest initial margin. Initial margin depends on the country that you are trading in, the guidelines of the exchanges, as well as volatility of the stock. So for example, in our case, let's say the initial margin requirement is 50%. Okay, so amount that you have to put in is not $170, it is 50% of that. So assume you're going to trade in 10 stocks. Okay, so the total trade amount, you're going to trade on 10 stocks. So the total trade amount is the share price multiplied by the number of stocks you have traded. So you are trading on $1,700. So you're buying stocks worth of $1,700. But are you putting in the entire amount? No. You're just going to put in initial margin, that is 50%. So you're just going to put in 50% multiplied by the traded value, that is $850. So by just putting in $850, you got an position worth $1,700. Now the key point is, the rest of the amount is loaned to you by the broker. So you have to buy stocks by paying $1,700. You put in $850, rest of the amount is loaned to you by the broker or the dealer. So loan amount is total traded amount minus the initial margin that you paid, that is loan amount. How is initial margin amount calculated? Initial margin percentage multiplied by traded amount. Okay. How is loan amount calculated? Loan amount is calculated as total traded amount minus initial margin amount that you have incurred. Okay, so this is the loan. Now broker will charge a certain percentage on this loan amount. Now this loan amount, this percentage that the broker charge is generally the call money rate, the borrowing rate that is going on in the economy, plus the spread. So brokers generally add a certain spread to the call money rate and they charge that interest rate on the borrowed amount. So assume that it is 11%. Now this 11% is generally stated in yearly terms. So if you're trading for a duration less than a year, then you need to readjust the interest rate. Okay, so you would have to pay 11% on the borrowed amount yearly for towards the broker who is letting you to borrow that amount. Okay, now you paid 850, you borrowed 850, you got into a margin buy position. Okay, so let us take situations of what will happen if the stock price goes up and goes down. So if the stock price goes up to, let's say, $200, what would happen? The entire world is buying the stock at $200 now, right? But you have bought the stock at $170. So something that is traded at $200, you are buying it at $170. So are you making profit? Yes, you are making profit. How much is the profit? Profit is difference between the share price, the current share price, minus the price at which you bought. So $30 profit per share. How many shares you were trading? So total profit would be 30 multiplied by 10, that is $300. This profits gets added to margin amount. So profit and loss are adjusted from margin amount, and this concept is called as mark to market. Okay, this profit gets added to the margin amount. So your margin amount will show $850 that you have put in plus $300 of profit. So your margin amount will show 1150. Okay, so if you say percentage gain that you have got is, you got in 1150 at the end of the trade divided by $850 that you invested. So your percent profit is somewhere around 35%. Okay, if you traded in cash, the profit would be $200 is the share price, $170 you bought it, so it will be somewhere around 17.6% or 18% if you trade it in cash, but the profit jumps to 35% if you trade in margin. So margin has leverage, it magnifies the profit as well as loss. Okay, so let's look at case 2. If the stock goes to $150, what would happen? The stock is being traded at 150, but you bought it at 170, so you would make a loss of 150, that is the current price, minus 170, the price at which you bought, so 20. Now this is loss per share, so you are trading in total 10 shares, so you would have a total loss of $200. So this loss is subtracted from the margin. So profit and loss is adjusted from the margin. So your margin will show $650 in it. So you have a percentage loss now. Percentage loss is 650 is the amount that you have. You deposited 850 minus 1. So you lost 23% of your margin. If you would have traded in cash, the stock was at 150, you bought it at 170, so you would have lost only 11%, while in margin trade you lost somewhere around 24%. Okay, so thing to remember, margin by position makes money when the stock goes up, it loses money when the stock goes down. Second point, profit and loss are adjusted from the margin amount. So initial margin that you put in, profit and loss gets adjusted from it. Third point, profit and loss are magnified in margin trading. So there is leverage that you are taking, you are just investing a part of a fraction of the sum required to take position. So whatever profit and loss you get, it is magnified. All right then. Certain other concepts. Now if the stock starts falling, and if you have invested $850, so loss is getting adjusted from it when the stock falls, right? So if the stock falls too much and this margin amount is wiped out and you get into negative, then you would have to pay the broker the difference and you may deny to pay. Okay, so for safety of the broker, that the stock shouldn't fall too much so that you may deny to pay him, the risk of the broker goes up. So brokers generally ask you to have certain maintenance margin. What is maintenance margin? It is the level of margin you have to maintain in the account to stay in the trade. If the margin account goes below maintenance margin, you will get a margin call in which you have to either increase the margin back to the initial margin level or you have to close the trade. Okay, so assume maintenance margin is 30% in this case. So maintenance margin is the stock price, the total traded value multiplied by 30%, 510. So if due to losses your margin amount goes below 510 or at 510, you will get a margin call in which you have to either increase it to the initial margin level, or close the trade. Now there is a trick involved. Let's say you get a margin call. So in margin call, you have to increase the margin amount. So put in additional cash. This is called as variation margin. And this variation margin is nothing but amount required to bring the margin to the new initial level. Okay, amount required to bring the margin to the new initial level, not the old initial level. That's the trick involved. So let's say the stock you bought it at 170, you did this margin call trade, margin buy trade, and the stock goes to 130. Okay, so what is happening? You're getting a loss. The loss is 130 minus 170, the price at which you bought it. So $40 loss, and you're trading on 10 stocks. So total loss is 40 multiplied by 10. So $400. This loss is adjusted from their margin. So your in margin account that you put in would be $850 that you deposited adjusted by minus $400 loss that you got. So your margin account will show $450. Now this $450 is less than $510 that are required to stay in the margin. Okay, so what will happen? You will get a margin call. So it is lower than maintenance margin. Maintenance margin was 510. Your account is showing 450. So you'll get a margin call. So you have to add in the variation margin. You have to put in the additional money to stay in the trade. How much additional money? So initial margin was 50%. The stock is at 130. So margin to stay in the account is 130 multiplied by 50%, 65 into 10, $650. So you have to have $650 now to remain in the trade, but you have only 450. So how much additional money you have to put in? That is called as a variation margin. Additional money you have to key in is 650 minus 450, $200. So if you put in $200, the broker or the dealer will allow you to trade, otherwise he will close the deal. Okay. The last point, there is a formula that you can be asked in the exam. That formula is price at which you get a margin call in a margin buy trade. So price at which, there is a formula for that. It means it is margin amount you deposit divided by number of stocks you are trading on minus initial margin percentage multiplied by number of stocks. Okay, so price at which you get a margin call, this is the price of the stock. So stock price at which you will get a margin call. Now just for the concept part, sorry for the interruption, I had just ordered in food, so that guy came in, so I had to take the delivery. That's okay. So we were discussing price at which you get a margin call when you do a long trade, okay, in margins. So the formula is margin, the total amount of margin, divided by number of stocks minus initial margin multiplied by number of stocks. So let us key in some figures and understand it. What is the margin amount that is required to trade here? It was initially 850 divided by number of stocks. How many stocks were you trading? 10 minus initial margin percentage, that was 50%. Oh, in the formula it is maintenance margin. You are getting a margin call, so it is maintenance margin percentage, not the initial margin. Okay, so 10 minus maintenance margin percentage, that is 30, multiplied by number of stocks again, that is 10. Okay, so if you key in the formula, it is 121. So if the stock falls to $121, you will get a margin call. Currently it is at 170. So you're safe till 121. After 121, you have to put in the variation margin or close the trade. Okay, so key points to remember when you do a margin trade. You don't have to put in entire amount, you just have to put in initial margin. There is a maintenance margin level. If the stock falls below that, you will get a margin call. Margin call means you have to add in the additional amount. And the basic part, that is in long trade, you benefit if the stock price goes up and you lose money when the stock price goes down. Now the second part of it, margin trade short. Okay, now it is tricky to understand, so I'll just write down the steps that you do, then try to explain it. In margin trade, you sell the stocks by borrowing the stocks with a commitment to return the stock. So just hold your guns, you would understand it, trust me. First is you borrow the stock. Now you need to guarantee that you would return the stock. For this guarantee, you have to put in some margin amount. That is, you have to deposit some value. Third, you sell the stock. Fourth, you buy it at a later date. and return the stock. Fifth, depending on the difference between the price at which you sell and the price at which you buy, your profit and loss is there. So either you have a profit or you have a loss. So either you have a profit or you have a loss. Profit and loss are adjusted from margin amount by the concept called as mark to market. So let us take an example to understand it. Let us continue with the same example. Apple stock at $170. Okay, borrow the stock. You borrowed it from the broker. You got the stock. Broker wants, so you borrow. Okay, now broker wants a guarantee. The guarantee is that no matter what the price is, you would at a later date return the stock back to the broker or the dealer. Okay, so you have to give some guarantee. This guarantee is you have to deposit some amount with the broker. Okay, so you deposited, let's say 50% amount was the initial margin required. So you are trading on 10 stocks, so you are borrowing 10 stocks. So the total amount you deposit is 170 multiplied by 10 multiplied by 50%. So you deposited $850 with the broker to trade. Now you sell the stock in the market at the market price. So market price assuming is 170. So you sell it at 170 multiplied by 10. So you get $1,700. So in your margin, you deposited $850 and you got $1,700, $1,700 by selling the stock. So you get $2,550 in your account. 1,700 of it comes from selling the stock, 850 you deposited. Now this is your margin amount. Okay, now what is the guarantee? That you will buy it at a later date no matter what the stock price is. So case 1, the stock falls to $150. So you have sold it at 170 and you have got 170 for it. Now there is a guarantee that you have made that you have to buy the stock and return the stock back to the broker. Now if the price is 150, you can buy it at 150. So what is happening? You sold it at 170. Now you're buying it at 150. The difference is your gain. So you're making a gain of, you sold it at 170. Now you're buying at 150. $20 per stock multiplied by 10. So your profit per share is 20. Your total profit is $200. This will reflect in the margin amount. So your margin amount will show 2750. Okay. Case 2. What is the percentage profit you are getting? You got $200, but to get $200, you deposited $850. 1,700 is not your deposit. $850 is your deposit. So you made 24% on it. But if you cannot sell in cash, so there is no thing we have to discuss about cash selling. You cannot benefit in cash sell by when the stock price goes down. Case 2. The stock goes to $200. Now you have sold it at 170, but the stock is now at 200. No matter what the price, you have to buy it now. So you have sold something at 170. Now you have to buy it back at 200. So you would have a loss of 170 you have sold it at, 200 you are buying it at, $30 per share. Total loss 30 multiplied by 10, $300 per share. This will be adjusted from your margin. So your margin shows 2250, and you're getting a loss percentage. So you have lost $300, you invested 850 minus 1, so you're no need to do minus 1, so you're losing 35% amount, so your loss is 35%. So like in margin buy, in margin sell, profit and loss are multiplied because you're just depositing a fraction of the amount. Okay, now same way that we have maintenance margin in margin buy, we have a maintenance margin in margin sell also, that is, let's say 30%. Again the concept is same. If your losses, if your margin amount goes below 30%, so you will get a margin call in which you have to deposit the additional margin or get out of the trade. Okay, so just to summarize the entire discussion that we had, there are two types of trade: margin buy, and I'll just zoom it so that it is, the visibility of this is better. Margin buy and margin sell. So when does margin buy benefit? When the stock goes up. So I am writing profit when the stock goes up. When does margin sell benefit? When the stock goes down. So you get profit when the stock goes down. Then when do you make losses in margin buy? When the stock goes down. When do you make losses in margin sell? When the stock goes up. Now, do you have to deposit entire amount to trade? No, just the initial margin. Here also you have to deposit initial margin. Okay, what do you do? You borrow money. Here you borrow stock. Okay, again there is maintenance margin level, and here also there is maintenance margin level. Again you have to pay interest here, that is call money plus the spread, and you have to pay some commissions because you are borrowing the stock here also. So this is the summary. Important point to note: buying, margin buy benefits if the stock goes up, margin sell benefit if the stock goes down, margin buy loses money when the stock goes down, and margin sell loses money if the stock goes up. So we had a quick review of chapter 2, so stay tuned, we'll be having a review of chapter 3 also.